On $5,000, you can make $100 a day, right? That's 2%, or $50 a day. That's 1% a day. If you had $15,000, you can make up to $300 a day, Monday through Friday, or $150 if you get 50%. If you had $100,000 doing this strategy, it can literally be life changing. In this video, we're going to be discussing the 1 DTE strategy and how amazing it can be with your quest for supplementing your income or making trading your primary source of income. The 1 DTE, or 1 day to expiration, is an amazing type of trade that can be executed even if you have a small an account. Now, you've probably heard of 0 DTE trading or day trading with the SPX. That strategy, you're going to need at least $25,000 in your account to be able to avoid the day trading pattern rule if you're trading with the margin account. If you're trading with the cash account, then you potentially get past that. But most of us, we have margin accounts, and we are trying to avoid the day trading pattern rule if we're trading with a small account, something under 25K.
Happy trading!
In this video, we're going to explain why the 1 DTE trade can be just as powerful as the 0 DTE trade with a little less risk, because the 0 DTE trade has the most gamma risk. Gamma measures the rate of change of delta, and delta measures your directional risk. And gamma is measuring how fast that directional risk is changing, and it's nothing more powerful than a 0 DTE trade when it comes to gamma risk. The 1 DTE trade is the second most, but it's 50% less than the 0 DTE gamma risk. Yes, you do have overnight risk when you're doing a 1 DTE trade. Something can happen overnight that you have no control over, but that's rare, right? That's super rare. And as long as you have your risk management process in place, you should be fine. Right? Your risk management process is that you have on a spread that's going to minimize your loss, and you're normally going to be 1 or 2 times the expected move. So that's going to give you some cushion. And if the market is super volatile the day before you put on the trade, or the day you put on the trade that's going to expire the next day, then it's going to reflect that in the expected move. So you're going to be able to factor out a lot of that overnight risk. Is it going to be a time that the overnight risk bites you? Absolutely. Absolutely. We've been trading the 1 DTE trade at the Dorian way for over a year, and we've never woke up the next morning with the position in the money. Right? It's been close a couple times, and we expect it to happen because we don't want to be fooled by randomness. We know it's going to eventually happen, so we try to protect ourselves by being as vigilant as possible with the steps that we take, because the only thing you can control is when you put on the trade. Right? You can control all the factors when you put on the trade, and then you at somewhat the mercy of the market after you put on the trade. Yeah, you can make an adjustments, and we teach you that, but if you have a small account, if you have an account that's just say $5,000, which we recommend you have at least to start doing this type of strategy, then you're not going to be able to do a lot of adjusting besides a rollout adjustment. Now, let me step back for a second and just point out that if you don't understand what I'm saying at this point, then you're not ready for this type of trade. We just talked about that the 0 DTE trade is the most risk, and this 1 DTE trade is the second most risk, but it can be an amazing trade. So this is why we're talking about it. This is why we're trying to introduce it, so that you can consider it and prepare yourself for it. You can make an amazing return off this 1 DTE trade, and it's a lot less risky than the 0 DTE trade, which you can make the most on because you have the most risk, but it's not for everyone. It's not for everyone. I think the 1 DTE trade is not for everyone, but it's for more people than the 0 DTE. So when you're doing the 1 DTE process, you want to factor in a few things that we're going to discuss on this video. Right? It's more things because of adjustments and so forth. And like I was going to say, if you do not understand that, then you shouldn't be doing this trade yet. Right? You shouldn't be doing this trade yet. But if you have $5,000 and you understand the process of adjusting, you understand what is a roll up, what is a roll away that we coin at the Dorian way, what is a roll out. If you understand those terms and how to execute it, then a 1 DTE trade can be life changing. It can be a strategy that significantly enhances your monthly income. Amazing supplemental income it can be. Or it can be your primary source of income. You can make a ton of money with this process. So let me explain. The way we try to teach it at the Dorian way is that you try to make $100 for every $5,000 in your account. So if you had $5,000 and you made $100 in one day, that would be a 2% return. Absolutely amazing type of return in one day on your account size. If your account size was $5,000 and you made $100, then that would be a 2% return. So just imagine doing a 2% return 5 days in a row. Monday, Tuesday, Wednesday, Thursday, and Friday. You had a 2% return every day of the week. So you're not going to win all the time. Okay, you're not going to win all the time, and you don't want to hold positions to expiration. That's our opinion at the Dorian Way. You don't want to hold positions to expiration. You can, and some people do. But for me personally, I try to get out of these 1 DTE trades within 30 minutes of the market open. And most of the time, you're going to be able to get out of those trades at that time with a profit of 50 to 70%. So if you collected $100 and you get out at 50%, well, that's $50, and that's 1% return on 5,000. That's still amazing, absolutely amazing, and you're giving yourself a higher probability of winning, a higher percentage of the time you're winning, because you're going to get to 50% profit a lot more than you would get to 100% profit. And so you're going to try to collect at least $100. Sometimes you're going to collect 120, 150, 170, but you want to try to collect at least $100 and get out of the trade between 50 and 70%. And the way I trade it, I'm trying to get out of the trade within 30 minutes of the market open. Most of the time, I'm out of the trade that way with a profit of 50 to 70%, sometimes a little less than that. And if I'm down on the trade within 30 minutes of the market open, then I'm going to decide to exit the trade or adjust the trade at that point. It all depends on if it's in a risk zone that we consider at the Dorian Way. We have what we call the green zone, the yellow zone, and the red zone. The red zone is the risk zone, the zone you should be considering making some type of adjustment. So if I'm not out of the trade within 30 minutes of the market open, then I'm going to decide to take whatever profits I had at that point or do some type of adjustment. It can be a roll away if I'm going to stay in the same expiration, but if my account size is small, I have to manage my day trading count. How many day trades have I completed? And I'm going to go over that. So most of the time, if you have a small account under 25K, you're going to have to consider rolling out at that point if you don't have any profits and you're going to stay in the trade. So when do you exit the trade? When do you exit the trade? So you have $5,000 that you initiate the trade with on this 1 DTE trade, and you're using no more than 2,000 to initiate. So you have another 3,000 at your disposal to be able to adjust the trade, to be able to see if you can win. So if you roll out, you can decide to increase the width of the spread. If you're starting with the 20-point wide, what we teach at the Dorian Way, you can decide to change that to a 25-point wide, a 30-point wide, a 40-point wide, or you can decide to go from one contract to two contracts to be able to increase your probability of winning when you had to make that adjustment. So we're going to show you that here in a second, what we're talking about, at least the setup of the trade. All right, so let's jump into the setup of the trade. So when we do the trade, we are looking for the VIX. We try to figure out what is the VIX trading at. If the VIX is at 13 here, 13.33, we do what we call the rule of 16, and we will divide the VIX by 16 to get the percentage move for that day. That works for 0 DTE trades and 1 DTE trades because it's based on a 1 day percentage move. We're going to look at the expected move on the platform. We're going to look at the straddle expected move that looks similar to something like this, and we're going to determine what is the 2 times the expected move by the straddle price or what's on the platform. As you can see here, this is the straddle price here, and then this is what is on the platform, the TastyTrade platform. So let's just say the expected move was $40 here. So we're going to try to be more than 40 or at least $40 away to initiate the trade and do a 20-point wide spread. This is like a 1 DTE trade. It's saying 2 DTE trade, but this is the weekend. It's not going to be trading on Sunday. So this is like a 1 DTE trade, using this as an example. So if we were going to go 40 points, we basically go to the 46.20. So the 46.20 would be right here. It's about a 7 delta. And that is, if we did on the call side, if we did a 20-point wide, you'll see we're getting $70 on that 70 delta. And then if we go 40 points from the put side, it's going to be basically around 45.40. And so if we sell that, that's around an 80 delta there, and an 8 delta there. And then we have a 20-point wide. So you can see with this trade, we're getting $125, and we have a probability of, you take the probability of 8 and 7, that's 15. So we got at least a 85% chance of winning on this trade because I'm taking the 8 delta on the put side, the short leg, and taking the 7 delta on the call side. And so we add that up, that's 15. And so you subtract that 15 from 100, and then that's going to give you the 85% chance of winning at least something at expiration, right? But we're going to try to get out of this trade with between 50 and 70%. So that's going to give us a higher probability than this 85%. We're going to have a 90, potentially 95% chance of winning on the trade. So this is a quick little kind of overview of the setup process, right? And so if the trade starts to go wrong, then it's going to be one of the sides that's going to be a problem, right? Because this is an iron condor we're setting out. So if the market starts to go down, then you can, in a big way, you're going to have a problem on this put side. If the market starts to go up, and this is going up on an option chain, you're going to have a problem on the call side. Okay, you're going to have a problem on the call side. So you cannot lose on both sides at the same time. You do have risks in both directions when you put on an iron condor, but you cannot lose at the same time in both directions. So if one side is giving you pressure, the other side is basically going to be a full winner. So what you would do then, if you had a $5,000 account and you decided that, okay, I'm going to roll it out, well, you're going to take off the entire trade, and the entire trade, let's say, because you had a problem with the trade, let's say the entire iron condor cost you, let's just say for example purposes, $300 for the trade, right? It's $300. So what you would do is you would have to roll out to try to get that $300. So let's just say this was the next day. You decided you were going to roll out the next day, right? So we're going to use this as the same example. So you decide you're going to roll out the next day, and you're going to go to a 14 delta here on the call side, and you're going to do a 20-point wide, and then you're going to decide to go to a 13 delta on the put side here, and you're going to do a 20-point wide. So if you did this, then this is only going to give you $260. It cost you $300 to buy back the trade. So you're going to have to decide at this point, are you going to go to a higher delta? Right? Are you going to move this up to a higher delta, or are you going to increase the width of the spread, or increase how many contracts you have to be able to account for the money that it costs to buy back the original trade and roll it out? So in this case, let's just look at them both really quickly. Let's say we decided to make it 25 points wide. So that's the call side, and this put side we made it 25 points wide. So that's only 285. If that's not going to work, right? Let's say we made it 30 points wide, and so that's 290 now, and on the call side that's going to be 295. So that's not working at this point. We can obviously go wider, and it's not going to give us too much more on the call side. On the put side, if we went wider, that's going to give us 310 there, and on the call side, if we went a little wider, that's going to give us still basically 310. So that's an option, and but keep in mind you at the 14 delta, and I just say you have the 14 delta on both sides. It's 14 and 14 is 28. You minus that from 100, and that's going to give you about a 72% chance to win on this trade, to win something on this trade at expiration. And if you hold it at expiration, obviously we don't hold things for expiration. Even if we make an adjustment, we're just trying to win on the trade at this point. If we had to make this type of adjustment, so that probability is not bad. But if you wanted to increase the probability, what you can do is potentially stay at the move it to the 10 delta, stay 20 points wide, move this to a 10 delta, stay 20 points wide like this, and then you can decide, okay, I'm going to add a contract, right? So if you add a contract, so now you're going to get 360, as you can see here. Your max profit now is 360. You needed 300, right? Now you collected $60 more. You collected $60 more. So yeah, you increased your potential risk, but you also still have a super high probability of winning, right? Because now you have the 10 delta on both sides. We do that probability calculation again. 10 and 10 is 20, minus that from 100. We got an 80% chance of making at least something on this trade, right? So you're going to get out sooner than that, but this is the concept, right? So you originally received, just really quickly here, you originally received, I just say $100. Right? We received a little bit more than that, but let's say you received $100, you had to buy it back for $300. So now you're down $200. Okay? And then you just put it back on, you rolled it out, and you got another 360, right? You got another 360, and so now you have one, now you got a net 160 in credit, right? So as long as you buy this back for 160 or less, not including fees and commissions, but it's just for simplicity purposes here, we're going to say as long as you buy it back for 160, you're going to win. So the current trade is trading for 360 when you roll out. It's 360. So you need, if you get half of that, that's going to give you 180. So you're basically going to need about 60% of the new trade, and then you can get out with a profit. Okay. All right. So this is a quick demonstration on how powerful the 1 DTE strategy can be. Right. So you can make on $5,000, you can make $100 a day. Right. That's 2%, or $50 a day. That's 1% a day. If you had $15,000, you can make up to $300 a day, right? Monday through Friday, or $150 if you get 50%. Okay? If you had $100,000 doing this strategy, it can literally be life changing. You make $2,000 a day because you're basing it on 5,000. So 100,000 divided by 5,000 is 20. You're making $100 times 20. That's 2,000. And so if you held it to expiration, that would be $2,000 a day, Monday through Friday. If you get out at 50%, that would be $100 a day, Monday through Friday, or $5,000 a week, $20,000 in a month. Life changing. So if you're interested in learning more, look at some of our other videos. Consider joining the Dorian Way. Please like and subscribe to our channel and leave a comment, good or bad. And we hope to see you in another video. Bye for now.